Kimberly here with Money Magic Revealed. Today, I just want to talk to you about understanding how it works to invest in the stock market and the benefits of doing so. So, let's just start with the basics. What do you get when you purchase a share of stock? Well, you get something called equity. And equity just means ownership in the company. So you're not the only owner. There's going to be hundreds of thousands, if not millions, of owners in each public company. But when you purchase a share of stock, you do get a little bit of ownership of that company. So, what's the benefit of having ownership in a company? Just so you can say, hey, look at me, I own part of Amazon. No, the purpose of it is that you are hoping to purchase that share of stock when it's at a low price and then sell it when it's at a higher price, whether that be a week later or that is 30 years later. Now, I do not recommend that you do day trading where you are buying stock one day, selling it the next, and you're just trying to make a quick return. That's more like gambling, and that's not what I'm referring to here. My focus is long term. So you buy stock and maybe you watch it for 5, 10, 20, 30 years before you even consider selling it. That also helps a lot with the risk of purchasing stock because the big risk here is that you're going to purchase it and you think it's at a low price, but then it just falls lower and lower and lower, and then you end up losing money. Well, if you do that just over a few days, then yeah, you might lose money that way. But if it's a good, solid company, then likely, even though they'll have some lows, they're going to have highs that will make up for those and hopefully make up for them and then have a much bigger return than what you put into it in the first place. Another benefit of owning stock can be dividends. So, dividends is where a company they make profit and they decide they want to share some of that profit with those people who believed in them and invested in their company. So dividends could be 18 cents a share or it could be $1.50 a share, and they might do it every quarter or maybe once a year. Now, not all companies are dividend paying companies, and none of them are required to pay dividends. But a lot of companies are known for paying dividends because they like to put some of that money that they made back to those who invested in them. So typically, companies that pay dividends are more stable companies that are not trying to grow drastically in the near future. So a company like Walmart often pays dividends. They've been around for several decades and they are very stable. When you invest in Walmart, it is not a big risk. We are not expecting Walmart to go out of business over the next couple of years. So investing in them, you know that they're not trying to do some huge expansion. So they're not necessarily going to grow. Your stock's not going to double in a year, but it should be stable and should slowly increase. An investment like that, that's just stable and going to increase a little over time, is called an income investment. Those are less risky. Now, a growth investment would be something more like Tesla, where it is up and down, which is what we call volatile. Volatile is the unpredictability of the stock market. So if a company is really volatile, we know that it is unpredictable. So when you put money in a company like that, it is going to be riskier because we really don't know what's going to happen next. They are trying to grow constantly, right? Elon Musk is always coming up with new crazy ideas. But that's one of the reasons he's the richest man in the world, right? Because he's able to implement those ideas and take those risks. But for that reason, Tesla is not known for giving dividends to their shareholders because instead they're taking their profits and putting it back into the company so they can continue to grow and grow. So it's two different kinds of companies: the income investments that are going to be stable and you're not going to expect your investment to be at a high risk, but you're also not going to expect it to be growing really quickly. It'll just be slow and steady. And then there's the growth investments where they are going to be higher risk, but you're putting your money into those companies expecting that they are going to get bigger and bigger and your share of stock is going to be worth more. Okay, so the biggest goal with stock is to buy it when it's low and sell it when it's high. That difference is called dollar appreciation. So you could get some dividends in the meantime while you're holding that stock, which is awesome. But the main thing that you're looking for is dollar appreciation. So the whole concept of stocks can be really hard to understand, right? Because it's something that has value, but you can't touch it and you can't see it. So that is actually called an intangible asset, a little bit harder to wrap our heads around. So why don't we compare our goal with buying and selling stock to something that is tangible to kind of help us understand it better? So let's say that your little side job is purchasing designer shoes that are collectible shoes. You are not buying these to wear them, but you are purchasing these so that you can sell them for more money. So the goal is obviously to buy these shoes at a low price and then sell them for a higher price. So let's say that you found a really fantastic pair of shoes. You got them for $100. And you're like, that's awesome because I know I can resell these for 150. So you then are going to list them and you're going to sell them for that 150. It might take you a couple months, but you make $50 off of that. So you spent 100, you made $50 because you sold it for 150. That extra 50 bucks is called dollar appreciation. Same thing we're trying to do with stocks. We want to buy them while they're at their low price and sell them while they're at their higher price. But that can be really tricky, and that's where the risk comes in. So, what impacts the price of stock? It's just like those shoes. The price of anything has to do with how much the buyer is willing to pay for it. So, whenever you purchase a share of stock, you're hoping that everybody starts valuing that company at a higher price. So, there's lots of different factors that could affect stock, and I'm going to do a different video to really explain how to analyze stock and what can affect the price. But all of these different factors just makes the investors value their mindset on the company, what they think is going to happen in the future with the company change. And then that affects how much they're willing to pay for it. So you want to buy the stock when people are undervaluing the company, and you want to sell it when it's being valued at a much higher amount. In order to actually purchase shares of stock, there are numerous websites that you can do that on. So make sure that you check out my video on researching and purchasing stock to get even more details to get you started in becoming a successful investor.